They have a 203K loan program that at FHA, it is now only available for owner-occupants. A 203K loan program was available to investors up until about 1996. And then FHA discontinued it. Why did they discontinue it? Because it had done its job. It had solved the foreclosure problem for HUD. They no longer needed investors, and so they said, thanks, and we'll see you later. If you think that's not true, that's on the interview with FHA on the radio show. I asked that exact question, and that is why they got rid of it. FHA doesn't have a ton of foreclosures right now because they were really almost not in the loan business the last 5 or 6 years. But the country needs that loan program to be made available to investors so we can buy and fix these properties in greater quantities than we currently can get financed. There we go. Fannie Mae and Freddie Mac need to increase the number of loans they're willing to make to investors. I don't know if they're going to exist after another 45 days, but whatever the arrangement is, they are one of the largest lenders. And this is a policy change that just went into effect August 1st, 2008. For investment property mortgages with Freddie Mac, a borrower may now have 1 to 4 properties. Before it was 10. Fannie Mae is probably going to join that and cut their loans down to 4 as well. That is just not enough loans to solve this problem. I heard that Fannie Mae and Freddie Mac are going to open local offices in California so they can sell their glut of foreclosures easier. Wouldn't a natural target be the investor? And yet at the same time, they're cutting back our financing. Their financial situation is very desperate. Together, Fannie Mae and Freddie Mac, the two biggest U.S. mortgage finance companies, owned a record $6.9 billion of foreclosed homes on March 31st, compared with $8.56 billion held by all 8,500 U.S. commercial banks in savings and loans. They have a ton of inventory, and they're going to have a hard time getting rid of it. Oops. Stay. Now, there's a segment of loans that's coming up that's going to cause a lot of problems called the option arms. Right now, they only represent 10%. I don't know how to go backwards, so they only represent 10% of the entire loan portfolio. Oh, geez. Stay. Okay. This Alt-A option loan product only represents 10% of the Fannie Mae and Freddie Mac loans. It represents 50% of their losses. And let's take a look at a reset chart. Stay. This is a real important chart. The blue line on the far right, that was the original reset pattern that they expected for the option arms. When you got an option arm loan, you had 5 choices of payment: a 40-year amortized, a 30-year amortized, a 15-year amortized, an interest-only payment, and you had a teaser rate payment. Teaser rate payment got down to 1%. If you signed up for the teaser rate payment on a $1 million loan and it was 1%, your payment was pretty small, and it could only grow by 7% the next year, and the next year, and the next year. 7.5%, thank you. When that grew, it got added to the principal balance, and it's going to cause these loans to reset earlier. They hit a ceiling. It's either 110, 115, 120, or 125% of the principal original loan balance. And when it kicks in, it resets. And it resets to whatever the note rate is at the time, and it changes the payment dramatically, where you could literally have a doubling of the payment as soon as that occurs. This is a little bit of a problem. And now, in studying this, 90% of the borrowers, guess what payment they chose? The minimum payment. It's one of the reasons why you won't have people walking away from this option arm early, because to be honest with you, their payment at that teaser rate is cheaper than rent. So even if they're buried underwater, they'll sit there and wait until the reset because it's cheaper than any other housing solution they've got. So this reset now is kicking off earlier. That blue pile is now moved to the left, and it starts to peak at the end, at least this is what this chart says. It starts peaking at the end of 2009. Now, when you have a reset that causes a problem, these lenders are not foreclosing the second you have one late payment. They're waiting. You got 6 months late payment, they finally do an NOD. You got 4 months foreclosure process approximately in California. Now you have 60 days after that they get to stay before you can kick them out. Whatever reset's going to happen in December of 2009 becomes an REO December of 2010. This is a serious pile of properties that are coming our way. The loan balance on this type of loan is $100,000 more than the subprime balance. And one other thing that happens, when the lenders claim their earnings every year, they were able to claim the interest not paid as money received. So you're going to have a lot of lenders have to recalculate their books as to what they really made because it wasn't what they thought. Now this one maybe is a little radical, but you know what? It's worked before. Place a moratorium on all due on sale clauses. Let anyone willing to take on a payment take over the loan without qualifying. This would do, and I changed it to 4 things. It'd make it possible for investors to buy a lot of properties that would otherwise end up as bank foreclosures. It'd allow realtors and auctioneers to make commissions on properties with no equity but favorable financing. They could get in the middle of the transaction, just like a short sale they do now. The difference is that the buyer wouldn't lose their credit. That's number 3, allow the owner of a zero equity property to move on with their credit intact, able to buy another property immediately. That's a big deal. It also would improve liquidity in the system because we would be reusing an existing loan. We don't lack liquidity. We got $10 million of financing. Move it forward one time, and we've created $10 trillion of new financing. In the 80s, this was the foreclosure growth in the 80s. In the 80s, when I started in 1980, I refinanced my house to become an investor. I borrowed money at 17.5%. My wife actually cried when we signed the loan docs. Those were bad years. This is the price deterioration during those years. It was virtually nil. So you had a tremendous amount of foreclosures, you had a terrible interest rate, and you had virtually no price deterioration. Why was that? Time will tell. Well, inflation was almost over, but guess what? 56% of all transactions in 1981 happened because of an assumption of the existing mortgage that was in place in the 70s. That's what saved that market. They didn't have to go get loans that were 17%. They could take over loans that were 8, 9, and 10% because they were in the past. Bring back the simple FHA assumption. Before we used to send in $45, our name would take their place on the loan, and we owned the property. I think we need to do that again. The last one is remove HUD's 90-day holding period before we're being able to sell it. This is what we start with as investors. I recognize this because we just fixed this. Okay? I want that picture. Is it just going to cycle to the new one? Oh, I want you to see the fixed part. Go forward? Okay, I'm trying. Yeah, we missed it. We got one picture in between. Come on. All right, I'm going to give up. Trust me, we clean them up really nice.